Good morning, dear learners, and welcome you all to the next lecture of my course on financial literacy. We are discussing trading mechanism in the stock market, and in the previous modules we have discussed about the options and futures, and we have also discussed about the various trading sessions in the stock market. We in the previous lecture had discussed that one of the very important tool for the minimization of risk in the exchange processes in the stock market is the derivative contracts, and today we will be going to extend this particular discussion by discussing the concepts of risk minimization tool as well as the concept of hedging, the benefit that we can get with the derivative contract. So, in this lecture number 58, we will be going to discuss about the hedging and risk management tool. So, we are going to here discuss basically the concept of risk, the various types of risk involved in the investment, that is the unsystematic and systematic risk, and we will be going to discuss the concept of hedging, its advantages and the difference between the two types of practices, that is the hedging and speculation in the stock market. We will be also going to discuss about the various tools that we may use for the hedging, that is the derivative, and some non-derivative tools are also there that can be used for the purpose of hedging procedure. So, let us start the discussions related with the hedging and risk management tool, where we are going to discuss about the various types of risk that may be involved in the trading process. Now, risk is basically the chance of having financial losses or the decrease in the value of investment that an investor invests into the stock market. So, whenever there is any loss in the value of the total investment or the capital that an investor has made into the securities and stocks or asset in the financial market, then that particular loss in the value may happen due to the involvement of risk under the investment procedure. Basically, it represents a potential loss that we may face due to the various factors that may affect the risk involved into the investment procedure. So, risk basically may be involved due to various economic factors and social factors and some other factors that may be directly or indirectly related with a particular class of assets, such as the company's performance, company's financial statements, or the economic factors, economics ups and downs in the nation, or various other factors may contribute the degree of risk involved into the investment procedure. The various types of risk can be broadly classified into two types, that is the systematic and unsystematic risk. So, basically this classification has been made on the basis of the factors due to which the risk is present in the investment decisions. So, let us discuss the first one, that is the systematic risk. So, basically it is the type of risk that cannot be eliminated through the diversification involved into the investment strategy of the investor. So, it is a widespread risk that can affect the entire market or the economy. For example, if there is any change of the monetary policies or economic policy in the market that may pose a market risk or interest rate risk or inflation risk in the economy, then such kind of the factors cannot be controlled by the investors by diversifying portfolios, because it will be having an impact on each and every sector of the economy, and every asset class in the financial market will get affected due to the involvement of such kind of changes in the economic and monetary policies of the government in the nation. So, this type of the systematic risk cannot be controlled or managed by the investor only by the diversification of their portfolio. Then the next is the unsystematic risk. Unsystematic risk is that type of risk that can be avoided with the help of the diversification in the investment strategy. That means the unsystematic risk may affect only to specific companies, industries, segments of the society rather than the entire market. That means these types of risk may arise due to certain factors that may be directly related to the specific category of a stock or the company, and due to which their performance in the market may decline. And by diversifying your investment portfolio, you can very easily control the unsystematic risk involved into your investment strategy. Then there comes one more type of risks that may be involved in the case of the systematic risk, which is the market risk. Basically, market risk refers to the potential for loss due to the fluctuation of the overall market. So factors such as stock market crashes or changes in the investor sentiment may contribute to the market risk that cannot be controlled easily. Then comes the interest rate risk due to the revision into the monetary and economic policy of the nation. Interest rate risk may arise when there will be any change in the market interest rates. So this risk primarily impacts the fixed income securities. The bond prices may move inversely to the interest rate into the market. So this may consist of two different type of component. One is the price risk and the other is known as the reinvestment risk. So these risks may also affect the investment strategy of the investor. Then one more risk is there, which is known as the purchasing power in case of the unsystematic risk, which is inflation, commonly known as. So purchasing power risk is caused by the inflation. So this leads to steady rise in the general price level in the economy, and hence it lowers down the purchasing power in the hands of the consumer. So as the inflation erodes the purchasing power of money, with the same unit of currency may be lesser, and the buyers of the products and services can buy fewer goods and commodities with the same unit of currency in the market. So this means that if an investor income doesn't keep pace with inflation, the real income of that investor may decline in the market. Then comes the business risk. Business risk is a type of the systematic risk. It encompasses the internal factor that can impact the company's revenue and performance. So due to this particular kind of risk, if there is any decrease in the prices of the stocks or asset in which you are investing, you can take the diversification strategy and you can minimize the risk related with the business. So for example, failing to secure the necessary copyrights or patents for new product could allow the competitors to copy or introduce the similar offering, and that can again lower down the prices of a particular stock or a company's financial instrument in the market. There may be certain external factors that can contribute to the business risk, such as government regulations, restrictions, licensing procedures. This can also create business risks, such as if the government is banning any product in the national interest, then also this kind of risk may arise in the investment procedure. So these risks can be controlled by the investor with the help of the diversification of their portfolio. Next is the financial risk. It occurs when a company fails to meet its financial obligations, such as if they are not capable of paying off their debts or they are not meeting their cash flow requirements, then such kind of risk may arise. So this risk may include the credit risk, the risk of borrowers defaulting the loan, or liquidity risk. So such kind of risk can be minimized by the investor, so can be managed by the investor. So now let us discuss how we can minimize, or we can say the management of risk can be done in the investment procedure by the retail investor. So there is a concept which is known as hedging. So hedging is basically a risk management strategy that can be used by the investor for the purpose of minimizing the various types of systematic and unsystematic risk involved into the investment procedure of an investor. So, these hedging tools are used in the derivative market for protecting against the potential losses involved due to the fluctuations of prices of the underlying asset in the derivative market. So, this basically involves taking measure to minimize or eliminate uncertainty related with the risk or the price movement of the underlying asset. So, price fluctuations can be controlled with the help of the hedging. In finance, basically hedging is discussed as a technique that helps to limit potential losses resulting from unpredictable market changes. These changes may occur due to the involvement of the systematic and unsystematic risk. So, the hedging is used by investor widely for the purpose of safeguarding their portfolios from the adverse financial movement due to the involvement of the systematic and unsystematic risk. Now, the various advantages of the hedging procedure is that it helps to mitigate the risk. That means it helps to reduce the potential risk arising due to the price volatility of the unfavorable market movement. In derivative, the two different parties can negotiate between themselves against the future market fluctuations of the prices, and they can negotiate a strike price for the underlying asset that needs to be delivered under the contract, and they can control the price movement risk to a certain extent for the both parties. So, this procedure is the hedging procedure. So, price volatility to certain degree can be controlled with the help of the hedging procedure. It also enhances the income stability. It contributes to more consistent earnings for the hedging investors. So, especially during the periods of the market fluctuation, the hedging can help the investor to minimize the various impacts of the price fluctuation. Then comes the facilitation of the effective planning. The hedging can give you some special provisions of making effective plans related with your investment. So, with more predictable cost and revenue, it will become more easier for you to make a financial budget or plan on the basis of forecast of the price fluctuation in the market. It provides protection from uncertainties, as we have discussed that the price can be negotiated and a strike price will be decided in the contract with the help of the hedging procedure. So, this will help you to protect from uncertainty. If the prices will go up beyond the level in the market, then also you need to purchase or sell the asset at the strike price that has been negotiated under the contract. So, uncertainty can be removed in the transaction with the help of the hedging tool, and it will safeguard the business with unforeseen shifts in the change of the price fluctuation, currency rate or the interest rate in the economy. It increases the investor's assurance. That means investors feel more confident about knowing the companies and actively managing and minimizing the financial exposure in the market. It helps to support the exporters and importers of the commodities in the financial market. So, by hedging currency risk, the business, those who are in the import and export of the commodities, and international trade, they can protect themselves with the exchange rate volatility. So, the currency price fluctuations can also be very easily managed with the help of the hedging procedure. Now, let us discuss how the procedure of hedging differs from the speculation. Basically, in case of the hedging, the objective is to minimize or eliminate the risk. That means to manage the price fluctuation of the commodities or the underlying asset with the help of the derivative contract. Whereas, speculation's objective is to seek generating profit by taking the risk. So, all the investors who comes in the category of risk taker, they can take the help of speculation, and by taking the risk, they seek to generate more profit from the market with the help of the speculation procedure. Then comes the nature. On the basis of nature, hedging is a risk reducing strategy. That means we try to manage the risk with the help of the hedging tools, whereas speculation is a profit driven activity. That means when you want to achieve more and more financial returns from the market, in that circumstances speculation is done in the case of financial tradings. Then comes the risk involvement. In case of hedging, generally lower or limited risk is involved in the transaction, whereas in case of speculation, it entails higher risk with the possibility of greater returns or losses in the trading practices. Now, on the basis of approach, if we differentiate the two different concepts, hedging follows a conservative approach. That means it aims at risk management, whereas speculation is characterized as an aggressive approach. That means it aims at taking risk and enhancing the profits involved into the trading procedure. If we differentiate the concept on the basis of market perspective, hedgers basically need to be neutral in the trading practices for the future market directions of the prices, whereas in case of speculators, they make decision based on the market prediction or trends. So they seek the higher profits on the basis of taking the risk that may be predicted by the market trends. If we talk about the users, the hedging procedure is used by businesses, exporters, importers to protect the unforeseen events in the market, whereas speculation is done by the traders or investors who are looking for profit from the price movement of the assets in the financial market. So basically, the typical users of hedging is the exporter businesses who need to actually invest into the various financial instruments for the management of their business risk, whereas speculators only tends to take the risk for increasing the prices. Then comes tool utilized. So both the hedging and speculation may involve the derivative products such as the futures, forwards, options or swaps, and they all the four categories of the derivative, they all serve different purposes for the different type of users. If we talk about the consequences in case of the speculation and hedging, if the market moves unpredictably or unfavorably, then the hedgers may miss out on potential profit in the market, but they also avoid significant losses, whereas speculators could face substantial losses if the market moves against their prediction. Now, let us understand what are the tools that are available to an investor for hedging or managing the risk involved in the trading practices. So, one of the very important tool is known as the derivative, that is a financial contract or financial instrument that is used for hedging of risk. They basically derive their value from an underlying asset that is traded with the help of this financial contract, and that is why this is known as a derivative contract. Now, suppose that the price of a commodity, assume we have taken milk, increases, the price of curd and other dairy product in the market will also rise. In such case, the derivative will try to minimize the risk associated with the price movement of the milk, and the value of the contract will depend on the price movement of the underlying asset, that is the milk in such case. Now, there are various types of the derivative contract, that are the future contracts, forward contracts, and options contract and swaps contracts. So, there are four different categories of the contracts under the derivative instrument that may serve different purpose for different categories of investors in the market. A future contract is basically an agreement between the two parties to buy or sell an asset at a predetermined price on a future date for controlling the price movement of the underlying asset that is traded under the contract. So, these are standardized agreement, that means these exchanges are done with the help of the stock exchanges, that means terms and conditions are set by the stock exchanges and SEBI, and these are different from the forward contract, which is a non-regulated type of derivative contract. So future contracts can be customized, and this can be traded with the help of the negotiation between the traders, and it is traded on the exchanges. So any disputes, any kind of dilemma can be avoided very efficiently in case of the future contracts. Then comes the forward contracts. These contracts are similar to future contract. All the characteristics are same, but they are traded over the counter market. That means they are not traded with the help of the exchanges. So the forward contracts are customer tailored. They suit to the specific needs of the parties who are involved into the contract. So unlike futures, these contracts are not standardized and they have counterparty risk. So that means if there will be any default by the counterparty, no authority will help you or oversee the agreement in case of any dispute under the forward contract. Then comes the option contract. We have discussed in the previous module about the option contract, and we have discussed it gives the buyer the right but not the obligation to buy or sell an asset such as the stocks, commodity or currency at a specified strike price before the expiration date. So this may involve call option and put option. Whereas the last category of swaps, the swaps contract, basically it helps the two parties to exchange the pre-agreed cash flow. For example, if you have taken any loan and you are paying interest on those loans, so the payment of the interest rate are the two cash flows that needs to be done by the two different parties if they have taken loan on floating rate or fixed interest rate. So they can exchange their cash flows and they can avoid the risk of changes in the interest rate involved into their loan transaction. So based on the notional principal amount, which is the nominal value, these cash flows can be exchanged between the two parties to minimize the interest rate risk. So there are various categories of the swaps also, such as currency exchange, currency swaps are there, that also helps in minimizing the exchange rate risk involved into the currency transactions. Now, there are certain non-derivative hedging strategies are also available to the investor. Suppose that if you do not have financial expertise and knowledge about the derivative and you do not want to trade in derivative contract, then you can take these other strategies for the hedging of the risk involved into your investment strategies. So the first one is the diversification. So you can spread your investment across the different asset classes that are available in the financial market. You can also diversify your investment across various industries, regions, for minimizing the dependence on any single source of risk. So you can invest into equities, bonds, any fixed income security, as well as you can diversify your investment in automobile industry, in IT or in other different segments of the economy for the purpose of diversifying the risk associated with your investment. So this strategy follow the principle of not concentrating all your resources in one area. So don't put all your eggs into the same basket. That this particular principle may help you to minimize the risk related with your investment strategy. Next is leading or lagging techniques for managing the currency exposure. The currency exchange rate risk may be also involved to the various businessmen or entrepreneurs who are involved into the export-import business. So they can take the help of leading and lagging strategies for minimizing the exchange rate risk. So you can accelerate the payments or collection ahead of the anticipated unfavorable exchange rate movements for minimizing the risk related with the currency exchange rate. Or in case of lagging, you can postpone the payments or receipts to benefit from the expected positive shifts in the values of the currency in which you are trading. So these two methods can also be taken for the purpose of minimizing the exchange rate risk. After that, the next strategy is netting. In netting, the offsetting receivables and payables in the same foreign currency within the company or group may be taken for reducing the need for frequent currency conversion. So here, in case of netting, it's especially beneficial for the MNCs or the cross-border transactions that involves export and imports of goods and commodities. So netting basically reduces the number of times to convert one currency into the other currency in which we are trading our products and commodities. So this particular strategy can also be taken as a method to minimize the risk involved into the investment procedure. Now the next one is the home currency invoicing. Home currency invoicing strategy is basically a procedure where we request international clients to settle the payment in the company's domestic currency. So to avoid the currency exchange rate risk, you can ask your client to pay you the same currency of your country. So this transfers the risk of exchange rate movements to the client only, and you do not need to take any risk. That means it provides you greater predictability to the seller. Then next one is the back-to-back loan. This particular strategy is also known as the parallel loans. This parallel loan arrangement occurs when two businesses in the different countries can lend each other equivalent sums of money in their respective home currency for the purpose of making their exchanges more conveniently. So it eliminates the need to convert the currency for the exchange process, and it helps to avoid the foreign exchange risk involved into their trade practices. So back-to-back loan can also be taken an option for the payment of the trade that is done between the two different nations in two different types of companies. So this can also be taken as a strategy to avoid the risk. So these are the various types of strategies that an investor can take for the purpose of diversifying the risk related with the investment procedure. So in this lecture, we had discussed about the concept of risk, the various types of risk, that is the unsystematic and systematic, and we had discussed how the risk management can be done with the process of hedging. We had also discussed about the differences between the hedging and speculation, and we have understood that if we want to minimize the risk, we can take the help of hedging, and if we want to have enhanced profit from the stock market, speculation can be done. For hedging, derivative can be a very useful technique, but it needs a specific knowledge and expertise in the fields of derivative market, and if you do not have that much of expertise, you can take the help of these strategies also to diversify the risk involved in your investment strategies. I hope all these discussion will be helpful to plan your investment strategy and to maximize your future wealth. With this, I conclude my lecture. Thank you.